Welcome to the Deep Dive, your shortcut to getting genuinely well-informed. We pack these sessions with surprising facts and insights, really cutting through the noise. And this deep dive, it's custom-tailored just for you. Today, we're plunging into a really fascinating situation with Gambling.com Group Limited, ticker symbol GAMB.
Yeah, it's quite something. Right now, this company's shares are trading around, $10.26. But here's the kicker. Wall Street analysts, they're targeting between $17 and $18.50. And our own analysis, looking at its intrinsic value, suggests it could actually be worth anywhere from $16, maybe up to $21.
Wow, that's a massive gap, isn't it?
It really is a huge disconnect.
So the big question we're tackling today is why? Why is there such a significant difference? And, what exactly does it mean for this company and maybe for you thinking about this space? We'll be doing a comprehensive analysis of Gambling.com Group Limited, that's NASDAQ, GAM, using an in-depth research report as our main source. Today's date for the analysis is August 5, 2025. And this feels like a pretty pivotal moment for GAM, doesn't it? They're integrating some really transformative acquisitions, navigating this rapidly expanding online gambling market, especially in North America.
Absolutely. And a quick note for those following closely, we'll be covering the Q2 2025 earnings for GAMB literally within minutes of their release on August 14th, 2025. So definitely stay tuned for that update.
Good point. Okay, so we've broken this deep dive down into two parts for you. In part one, we'll unpack the core business, take a look at management, and dive into the financials. Makes sense.
Yep, sounds good.
Then, in part two, we'll explore market sentiment, who owns the stock, assess the risks involved, and then deliver our final outlook. Okay, let's start by really getting a handle on what Gambling.com Group actually does. What exactly is this company, and how does it make its money? Let's dive into Chapter 1, Business Analysis.
Right, so the first thing to grasp, and is crucial, is that Gambling.com Group is a performance marketing company. They are not a gambling operator. They don't take bets themselves.
Okay, they're not like DraftKings or FanDuel.
Exactly. Think of them as a critical intermediary, like a super specialized connector in the digital gambling world. Their main job is to attract and then refer high-intent online gamblers. These are people actively looking to place bets directly to their clients, who are the regulated online gambling operators.
High intent, so not just casual browsers.
Precisely. People ready to deposit and play. And the beauty of their model is that it's very asset-light, highly scalable. They don't need tons of physical stuff or massive capital spending to grow.
Okay, so they're finding the players, not taking the gambling risk. How do they actually get paid for making these connections? What are the revenue streams?
Historically, it's been mostly commission-based. There are a few main types. You've got cost per acquisition, or CPA. That's a one-time fixed fee they get for each new depositing customer, or NDC they send over.
Simple enough. One fee per player.
Then there's revenue share. This is where they get a percentage of the net gaming revenue, the NGR, that the operator earns from a player they referred. And often, this is for the entire lifetime the player stays with the operator.
Ah, so that could be ongoing income for a long time.
Potentially, yes. And finally, there's a hybrid model, which, as you'd guess, combines elements of both, maybe a smaller upfront CPA fee plus a lower ongoing revenue share percentage.
Makes sense. But I understand there's a really important evolution happening here, a strategic shift towards high-margin recurring revenue.
Yes, and here's where it gets really interesting for the quality of the business. They've made some key acquisitions, especially sports data platforms like OddsJam and OpticOdds.
OddsJam, I've heard of that one.
Right. These acquisitions have added a significant and growing subscription-based revenue stream. They offer sophisticated betting tools, real-time odds data, analytics, stuff useful for both serious individual bettors looking for arbitrage or positive EV bets, and also for enterprise clients.
So less reliant on just commissions now.
Exactly. This subscription part now makes up over 20% of their total revenue. It's a key driver for future growth because it brings more visibility, more predictability, more stability to their overall earnings. It fundamentally improves the quality of the revenue mix.
Okay, beyond the money side, what are their main products and services that generate this traffic?
Well, the cornerstone is still their affiliate marketing and content publishing. They own and run this portfolio of over 50 websites. We're talking premium domains like gambling.com itself, bookies.com, casinos.com, rotowire.com.
Those are some killer domain names.
Aren't they? These sites publish expert content reviews, betting guides, industry news, all meticulously optimized for search engines like Google. SEO is core to what they do. That drives a huge amount of organic traffic.
So SEO is key.
Absolutely fundamental. Then, With that OddsJam acquisition, they've seriously leveled up their sports data services, offering that real-time odds and analytics capability. And finally, they have media partnerships with big names like Gannett, the USA Today Network, and the McClatchy Company, where they provide content and monetize the betting traffic from those established media properties.
That sounds like a pretty comprehensive approach. What's their overall market position? How big are they?
They're definitely a global leader in the online gambling affiliate space. They operate across 19 different markets, 12 different verticals. It's pretty broad. But their strategic focus on North America has been incredibly successful. In 2024, North America accounted for, 73.1% of their revenue.
Wow, heavily focused there.
Yeah, that's where the big growth story is right now. And just to give you a sense of their scale and effectiveness, look at a key performance indicator, NDCs, new depositing customers. In Q1 2025 alone, they delivered over 138,000 NDCs to their operator partners. That was a 29% increase year over year. That's serious volume.
Okay, so boiling it down, what's the core value proposition? Who wins here?
It really works on two sides. For consumers, their websites are a free, comprehensive, and importantly, trustworthy resource. They help people navigate what can be a pretty confusing online gambling world. Find safe, regulated operators, get good info.
And for the operators, the DraftKings and BetMGMs of the world?
For the gambling operators, the value is crystal clear. Efficient, high-value customer acquisition. Gambling.com Group specializes in delivering that high-intent traffic. We talked about users who are basically ready to sign up, deposit, and start betting. For the operators, this means a much higher return on their marketing investment compared to, say, broad advertising.
Got it. Okay, let's zoom out a bit to the wider industry. What are the big trends driving growth?
The whole industry is riding some powerful secular tailwinds. The biggest one, undoubtedly, is the progressive legalization of online gambling in the United States. Ever since that 2018 Supreme Court decision on PassPA overturned the federal ban on sports betting, well, it opened the floodgates. State by state, the market is opening up.
The post-PassPay world.
Exactly. And it's creating one of the largest regulated online gambling markets globally. Beyond just the laws changing, you also see sports betting becoming much more normalized, integrated into mainstream media. Globally, the online gambling market is forecast to grow at roughly 9% compound annual growth rate through 2029. That's a strong, long-term tailwind supporting companies like GAMB.
Okay, but it can't be easy pickings. What's the competitive landscape look like?
Oh, it's definitely intense. Highly competitive and quite fragmented. They have direct, publicly listed peers. Companies like Catena Media, CTM, and Better Collective, BET Co., are probably the main ones people know.
Right, I've seen those names.
But they also compete with lots of smaller, private websites, niche affiliates, and even the big gambling operators themselves, who pour millions into their own direct marketing efforts.
And the regulations, you mentioned state by state in the U.S.
Yes, the regulatory environment is critical here. It's highly complex, very stringent, and it varies dramatically depending on where you are. In the U.S., it's this real patchwork of state-level laws. Each state has its own rules, licensing requirements, advertising standards, consumer protection demands.
Sounds like a compliance nightmare.
It's a significant burden, absolutely. You need licenses, you need to constantly monitor and adhere to evolving rules in every single jurisdiction you operate in. Think back to UIGA in 2006, the Unlawful Internet Gambling Enforcement Act that history casts a long shadow.
Does that complexity actually create barriers for new companies trying to get in? Does it protect incumbents like Gambling.com Group?
It absolutely does. These hurdles act like significant barriers to entry. First, the regulatory and licensing complexity itself. The cost and sheer difficulty deter many potential entrants. Second, achieving SEO dominance like GAMB has takes years of sustained investment in top-notch content, technical optimization, building domain authority. You can't just flip a switch or buy your way to the top of Google overnight.
So time and expertise are key.
Definitely. Then there's building brand authority and trust, having names like Gambling.com, Bookies.com. That carries weight and credibility that takes a long time to build. And finally, securing favorable terms and established relationships with the major gambling operators requires a proven track record of delivering high-quality players. They trust GAMB. So yeah, that complex U.S. regulatory landscape, while technically a risk, paradoxically functions as a pretty powerful competitive advantage for established players like GAMB. They have the scale and expertise to navigate it effectively.
Okay, so summing up their competitive edge, what are the absolute key advantages?
I'd point to four main things. One, brand strength and recognition. Those premium category-defining domains are invaluable assets, gambling.com, casinos.com. They provide instant identity, authority, credibility.
Hard to replicate.
Very. Two, Cost advantages or economies of scale. Their asset-light model, combined with their proprietary technology platform, allows them to operate very efficiently and scale up without proportional cost increases. 3. A kind of network effect or virtuous cycle. Quality content leads to high SEO rankings, which attracts that high-intent traffic. That traffic attracts strong operator partnerships with good commission rates. The revenue generated gets reinvested back into better content and technology, further boosting SEO. It's a self-reinforcing loop.
A flywheel effect.
Exactly, a flywheel. And 4, unique assets and capabilities. Their core competency in SEO is world-class. Their proprietary tech platform is a key differentiator, and they make very data-driven decisions across the business.
That gives us a really clear picture of the business itself.
Excellent. Let's shift gears now and look at the people running the show. Let's move to Chapter 2, Management Evaluation. So, what does this all mean when we look at the leadership behind Gambling.com Group?
Well, one of the standout features here is that it's a founder-led team. Charles Gillespie, the CEO, and Kevin McChrystal, the COO, actually founded the company way back in 2006. They've been steering this ship for nearly 2 decades.
Wow, that's a long tenure. Real commitment.
It really is. And it speaks volumes about their dedication and deep industry insight. They've also got a proven track record of strategic foresight. For instance, pivoting away from unregulated Asian markets towards regulated European ones back in 2010. And crucially, acquiring key U.S.-facing domains like bookies.com before that 2018 Supreme Court ruling blew the U.S. market wide open. They anticipated the shift.
Smart move.
Very smart. And they've shown resilience, too. Like when Google made those algorithm changes in 2024, they responded quickly, optimized their own and operated sites, and actually strengthened their long-term position. They know how to adapt. And how are they on communication and, ethics? Are they transparent?
They generally maintain high standards of communication, providing pretty clear financial guidance to the market. On the ethics front, their commitment seems solid. They were a founding member of the Responsible Gambling Affiliate Association, the RGAA, which promotes responsible advertising and consumer protection critical in this industry. And CEO Charles Gillespie is a respected voice, often engaging with policymakers. That builds credibility.
Okay, that leads nicely into capital allocation. How management uses the company's money is often a huge tell, right?
Absolutely. And this is another area where Gambling.com Group really stands out. The first thing that jumps out is the incredible alignment of interest. Why? Because insiders, founders, executives own approximately 45% of the company.
45%, that's huge.
It's exceptionally high. Mark Blandford, the chairman, owns about 25%, Gillespie around 13%. This means their personal financial success is directly tied to creating long-term value for all shareholders. They have serious skin in the game. It's also quite telling that there haven't been any open market sales by these key insiders over the last 12 months, or purchases for that matter. But the lack of selling is often seen as a sign of confidence.
Very strong alignment. So how have they deployed capital? What about M&A?
They've shown a disciplined and strategic approach here. They use their strong cash flow for acquisitions that are accretive, meaning they add to earnings per share, and that can be integrated onto their own tech platform to unlock more growth.
Yeah.
Don't just buy companies randomly.
Any key examples?
The big one, the truly transformative one, was acquiring Odds Holdings, Inc., the parent company of OzJam. That deal, potentially up to $160 million, brought in that state-of-the-art real-time odds data platform we mentioned. But more importantly, it brought that high-margin, recurring subscription revenue business. That deal is expected to be immediately accretive, adding something like $14.5 million in incremental adjusted EBITDA just in 2025. It fundamentally improves the quality of their earnings stream.
Game changer, potentially.
Potentially, yes. Yeah. They also acquired XL Media's European and Canadian assets for up to $42.5 million, strengthening their market share there. And earlier acquisitions like RotoWire and Bonus Finder helped build out their North American footprint before the big push. It's been strategic.
Okay, what about returning capital directly to shareholders? Dividends, buybacks.
Gambling.com Group currently does not pay a dividend. Their stated policy is to retain all earnings for reinvestment back into the core business, into M&A, and for share repurchases.
Buybacks. Are they active there?
Yes, quite aggressive, actually. In early 2024, they bought back over 329,000 shares at an average price of around $9.10. And on top of that, the board authorized another $10 million the buyback program. This is generally seen as a very strong signal from management that they believe the company's shares are fundamentally undervalued at current prices.
Buying their own stock back when they think it's cheap. Makes sense.
Okay, another critical measure of how well management uses capital is return on invested capital, ROIC. How do they stack up?
They stack up very well. Their trailing 12-month ROIC is a strong 20.4%. Some sources calculate it even higher, maybe up to 28% or 29%. The key point is that this is significantly higher than their estimated weighted average cost of capital, or WACC, which is probably around 7.5%.
So the return they're generating is much higher than their cost of funding it.
Exactly. That positive spread between ROIC and WACC is the hallmark of profitable growth and genuine value creation. It tells you management isn't just growing the business, they're growing it in a way that generates substantial returns on the capital invested. It's quite impressive in this industry. Okay, fantastic overview of the management and their strategy. Now let's dive into the numbers themselves. How does this all look on the balance sheet and the income statement? Time for Chapter 3, Financial Analysis.
All right, let's get into the figures, starting with some key metrics review. As of our analysis date, August 5, 2025, Gambling.com Group has a market capitalization of approximately $362 million. That puts it squarely in the small cap segment of the market.
Small cap, often associated with higher growth potential, but maybe more risk too. What about their revenue growth trends over, say, the last 5 years? You mentioned growth earlier.
The growth has been, frankly, spectacular. Looking back 5 years, 2020 revenue was about $28 million, 2021, $42 million, 2022 jumped to $76.5 million. That was over 80% growth. 2023, $108.6 million, still over 40% growth. 2024, $127 million. They've nearly quintupled revenue since 2020.
Incredible top-line growth. What about more recently?
Their trailing 12-month revenue, ending March 31st, 2025, was $138.6 million. That's still a healthy 24.7% increase year over year. And importantly, management's guidance for the full fiscal year 2025 is for revenue between $170 million and $174 million.
So they expect growth to reaccelerate.
Yes, the midpoint of that guidance implies roughly 35% year-over-year growth. It signals strong ongoing momentum and confidence from management.
Okay, high growth is great, but is it profitable growth? Let's talk profit margins.
This is another area where they shine, largely thanks to that asset-light, technology-driven model we discussed. Their margins look more like a software company than, say, a traditional media company. Their gross margin is exceptional, around 94.5%. Very little cost of goods sold.
Wow, almost pure profit on the initial sale or referral.
Pretty much. Their operating margin is also very strong at 28.5%, and their net profit margin is impressive at nearly 25%. They convert a large chunk of that revenue straight to the bottom line. And just to add another metric, their adjusted EBITDA margin for fiscal 2024 was 38%, and it even hit a record 42% in the fourth quarter of 2024.
So high growth and high profitability, that's a rare combination.
It really is. It points to a fundamentally scalable and efficient business model.
How does that high profitability translate into cash? What about free cash flow generation?
As you'd expect, strong profits lead to strong free cash flow. In 2024, they generated somewhere between $35.6 million and $41.5 million in free cash flow, depending on the exact calculation. Their latest trailing 12-month free cash flow was $38.7 million. That gives them a very healthy FCF margin of about 28%. This cash flow gives them significant financial flexibility for M&A, buybacks, or reinvestment.
Okay, moving towards financial stability, how consistent have their earnings been?
They have a consistent track record of profitability. Net income surged 68% in fiscal year 2024 to $30.7 million. And here's a key point underscoring their execution. They have beaten analyst consensus earnings per share, or EPS, estimates in each of the last 4 quarters, and often by quite substantial margins.
Beating expectations consistently, what does that suggest?
It often suggests that management might be guiding conservatively and that they have a very strong handle on their operations and forecasting. It builds credibility.
What about debt? You mentioned acquisitions. How does their debt-to-equity ratio look?
As of March 2025, their debt-to-equity ratio was around 0.60, or 60%. Now, that has increased, mainly to finance those strategic acquisitions like OddsJam and XL Media assets.
Is that level of debt manageable?
It appears quite manageable. The debt is well covered by their operating cash flow coverage is around 45%. And perhaps more importantly, their earnings before interest and taxes, EBIT, covers their interest payments by a very comfortable 11.4 times. So while debt is present, it doesn't look like a major solvency risk right now.
And liquidity, short-term health.
The current ratio is 1.06. Generally, a ratio above 1.0 indicates a company has sufficient short-term assets to cover its short-term liabilities. So their liquidity position looks sound.
Okay, solid financial footing. Let's finally turn to valuation analysis. How does GAMB look compared to its peers on, say, a price-to-earnings basis?
This is where that disconnect we mentioned earlier really comes into focus.
Yeah.
Gambling.com Group's trailing 12-month PE ratio is sitting around 10.6x.
10.6x, how does that compare?
Let's look at its main public peers. Catena Media, CPM, has a market cap around $130 million, but they're currently loss-making, so their PE is negative. Not really comparable on that metric. But Better Collective, BETCO, with a market cap closer to $780 million, they traded a PE ratio of roughly 30.0x.
30 times compared to GAMB's 10.6x.
Exactly. And remember, GAMB has significantly higher profit margins, that 25% net margin compared to Better Collective's 4.5% net margin. And GAMB's recent growth and forward guidance looks stronger too.
So a substantial valuation discount relative to its closest large peer, despite seemingly superior financial metrics.
Precisely. It strongly suggests the market might not be fully appreciating the quality, profitability, and growth trajectory of Gambling.com Group right now.
What about intrinsic value? You mentioned a discounted cash flow analysis earlier.
Right. A DCF analysis tries to estimate a company's true underlying value by forecasting its future free cash flows and discounting them back to the present. It's just one method and relies on assumptions, but it gives you a framework.
What were the key assumptions in this case?
We used a discount rate, or WACC, of 8.44%. That's derived using standard methods like the capital asset pricing model, factoring in things like current interest rates, the stock's beta or volatility, and an equity risk premium. For the free cash flow growth rate, we use a two-stage model. For the first 5 years, a high-growth phase, we assume 20% annual growth, which is actually conservative compared to their 35% revenue guidance for 2025. Then, for the perpetual growth phase beyond year 5, we assumed a modest 3.0% growth rate, roughly in line with long-term economic growth.
Okay, so reasonable assumptions. What did that DCF model spit out?
Based on those inputs, the estimated intrinsic value range came out to be approximately $16 to $21 per share.
$16 to $21, compared to the current price around $10.26.
Yes. Again, reinforcing that significant gap between the current market price and what a fundamental valuation analysis might suggest the business is actually worth.
Okay, that wraps up a very thorough look at the business, management, and financials. That brings us neatly to part 2 of our deep dive. With that fundamental picture clear, let's zoom out. How is Wall Street reacting? What's the broader market sentiment? Welcome to Chapter 4, Market Sentiment.
Well, if you look at Wall Street analysts covering Gambling.com Group, the sentiment is pretty much unambiguously bullish.
Really? How bullish?
The consensus rating among the, I think, is 8 to 10 analysts covering the stock is a strong buy. That's about as positive as consensus ratings get. Their average 12-month price target falls in a range of $17 to $18.50.
17 to 18.50 compared to the current $10.26, that implies a lot of upside.
It does. Roughly 65% to 80% implied upside from the current price. That indicates a very strong belief among these analysts that the stock is significantly undervalued right now. It's also worth noting the range of individual targets is pretty narrow, mostly between $17 and $20, suggesting a strong agreement among them.
What about recent news flow? Has that been positive?
Yeah, the general media tone and news flow around the company have been predominantly positive. Most coverage focuses on their record financial performance, that strong forward guidance, and the successful execution of their acquisition strategy, especially integrating OddsJam.
Okay, what about market indicators? Is there heavy short interest betting against the stock?
Not really. Short interest is relatively low. It's hovering between 3% and 3.6% of the float. The days to cover ratio, which indicates how many days of average trading volume it would take for all shorts to cover their positions, is around 4.0. That doesn't suggest a significant conviction-driven short bet against the company.
So analysts love it, news is good, shorts aren't piling in, but the stock price is lagging. You mentioned the moving averages earlier.
Yes, and this is the fascinating part. What's fascinating here is the clear and significant disconnect between this positive fundamental assessment and the stock's recent price action. Despite the strong results, bullish targets, and positive news, the current price of $10.26 is significantly below its 50-day moving average, which is around $12.40, and also below its 200-day moving average at $12.67.
So technically it looks weak, even though the fundamentals look strong.
Exactly. From a technical analysis perspective, trading below those key moving averages is generally seen as a bearish signal. This divergent strong fundamentals, weak technicals is really interesting. It could suggest the market is currently focused on short-term factors, maybe broader market weakness or sector rotation, rather than GAM's specific long-term prospects. For value-oriented investors, this kind of disconnect can sometimes signal a potential opportunity.
A potential mispricing by the market. Okay, very interesting dynamic there. Let's move on to who actually owns the company. Let's delve into Chapter 5, ownership structure. Who really holds the cards when it comes to the company's future direction?
Well, starting with institutional ownership, it's quite substantial. Institutions own roughly 40.8% of the outstanding shares. We're talking over 250 institutional owners holding more than 16.6 million shares.
Any big names among the top holders?
Yes, some well-known investment firms. Top holders include AWM Investment Company, BlackRock, G2 Investment Partners, ClearBridge Investments, and Dryhouse Capital Management. It's worth noting there's been some dynamic activity recently. Some firms have trimmed their positions, but others, like G2 and Dryhouse, have significantly increased their stakes. The net result seems to be an overall accumulation by institutions.
Okay, but the really striking part, as we discussed under management, is the insider holdings, right?
Absolutely. That's a dominant feature of the ownership structure. As we said, insiders hold approximately 45% of the company. That exceptionally high level creates that powerful alignment between management and shareholder interests.
Just to reiterate the key holders.
Mark Blandford, the chairman and an industry veteran, holds the largest stake at around 25.1%. Charles Gillespie, the co-founder and CEO, holds about 12.8%. And again, crucially, the lack of any open market fails by these key insiders over the past year speaks volumes about their confidence.
So, with insiders holding 45% and institutions holding 41%, that doesn't leave much for the public float, does it? How concentrated is the ownership?
It's highly concentrated. If you look at the top 25 shareholders, that includes the key insiders and the largest institutions, they collectively control a staggering 78.24% of the company.
Wow, nearly 80% controlled by just 25 entities.
Exactly. This creates what you might call a founder-control dynamic, even though it's a public company. On the plus side, this insulates management from short-term market pressures and allows them to focus on long-term strategic decisions. They don't have to worry too much about quarterly Wall Street noise.
But what's the downside of that concentration?
The main implication is that the influence of minority shareholders is pretty limited. If you're investing in GAMB, you're essentially placing your trust in the integrity, the vision, and the execution capabilities of this founder-led team and the large institutional backers. Your ability to influence company direction is minimal.
So you're really betting on the jockey, so to speak.
To a large extent, yes. Given their track record and alignment, that might be a good bet, but it's important to understand that dynamic.
Absolutely. Okay, no deep dive is complete without thoroughly examining the potential challenges and headwinds. Let's talk about the other side of the coin in Chapter 6, risk assessment.
Right. It's crucial to have a balanced view. We can think about this using a classic SWOT analysis: strengths, weaknesses, opportunities, threats.
Okay, let's start with the strengths. We've covered many, but what are the highlights?
Key strengths are definitely their dominant SEO and technology platform, that portfolio of premier brands, gambling.com, etc., the founder-led management team with that huge insider ownership, and their superior financial profile, high growth, combined with industry-leading profit margins and robust free cash flow generation.
And the weaknesses, where are they potentially vulnerable internally?
A few things stand out. There's some revenue concentration, meaning they rely on a handful of large gambling operators for a significant portion of their revenue. If a key relationship soured, it could hurt. There's also the inherent dependence on Google. Their SEO strength is a huge asset, but it also makes them vulnerable if Google makes major algorithm changes that negatively impact their rankings. And finally, there's always acquisition integration risk. They've made some big buys like OddsJam. Fully realizing the expected synergies and smoothly integrating these businesses always carries some level of challenge.
Okay, makes sense. What about the external factors, the opportunities?
The biggest opportunity is clearly the ongoing U.S. market expansion. State-by-state legalization provides a massive multi-year growth runway. Tied to that is the growth of subscription revenue from OddsJam and similar services. This recurring high-margin revenue could lead to a higher valuation multiple for the company over time. There's also potential for international growth to diversify beyond North America eventually, and the market remains fragmented, offering further strategic M&A possibilities.
And the flip side, the threats lurking out there.
The threats are significant and mostly external. The number one threat is probably adverse regulatory changes. A reversal of legalization trends, new restrictions on advertising, or unfavorable tax regimes in key markets could severely impact the entire industry, including JNAV. It's a constant background risk.
The regulatory ghost.
Always hovering, yes. Then there's the intense competition we talked about. New entrants or aggressive moves by peers could pressure commission rates and margins over time. Macroeconomic headwinds are another threat. A recession or high inflation could reduce consumer discretionary spending, which might impact gambling activity, although some argue this sector can be somewhat resilient.
And anything specific due to them being based internationally?
Yes, geopolitical factors. While not directly impacted by tariffs like manufacturing companies as a foreign domiciled company, they're based in Jersey, they could potentially be exposed to shifting international relations leading to things like digital services taxes or data localization laws aimed at foreign tech firms operating in markets like the US or Europe.
Okay, a comprehensive look at the risks. So let's pull it all together. If we connect this to the bigger picture,
Yeah.
what's our final takeaway from this deep dive into gambling.com group? Let's wrap up with Chapter 7. Conclusion.
All right, synthesizing everything, let's start with the bull case. What we have here is fundamentally a high-quality business. It's a leader in a structurally growing industry online gambling affiliation. It possesses a durable competitive moat built on superior SEO, those premium brands, and proprietary technology.
And guided by strong management.
Exactly. Guided by a proven, founder-led management team with that exceptional 45% insider ownership, ensuring alignment and disciplined capital allocation demonstrated by accretive acquisitions and opportunistic share buybacks. The ongoing U.S. market legalization provides a clear, multi-year growth runway. And critically, based on our analysis and Wall Street consensus, the company appears to be trading at a significant discount to its intrinsic value.
Okay, that's the bull case. What about the bear case, in summary?
The primary risks, as we just discussed, are largely external and mostly beyond the company's direct control. Regulatory risk, potential reversals, or new restrictions remains the most significant, perhaps even existential threat. The heavy reliance on Google creates platform risk. Intense competition could eventually erode margins. And there's always some acquisition integration risk with large deals like OddsJam.
And just to reiterate the valuation summary from our analysis.
Our educational discounted cash flow, DCF analysis, yielded an estimated intrinsic value range of approximately $16 to $21 per share.
$16 to $21.
Yes. So our concluding outlook is this. The current market price, around $10.26, stands substantially below both the consensus Wall Street analyst targets, $17 to $20 range, and our own estimate of intrinsic value. This significant gap suggests that the current valuation likely reflects short-term market concerns, maybe technical price weakness, rather than the underlying fundamental strength and long-term growth potential of the business itself.
So despite the risks,
Despite the material risks, particularly regulatory ones, the company's formidable competitive advantages, its exceptional financial profile, high growth, high margins, strong FCF, and that highly aligned and proven management team, well, it may offer a compelling opportunity for long-term, value-oriented investors who can look past the short-term noise.
that really crystallizes the situation. It certainly raises an important question for the future. As this whole digital gambling landscape keeps evolving, with more states coming online, technology advancing, how will companies like Gambling.com Group balance that drive for rapid growth with the ever-increasing regulatory scrutiny and, importantly, the imperative for responsible gambling practices? Something to think about.
Absolutely. And just a standard reminder, this analysis was generated by an AI system. It's intended for educational purposes only and should definitely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Sound advice. And if you want to stay ahead in the markets and get more deep dives like this one, remember to like and subscribe to the Stock Analytics AI YouTube channel. Members get priority deep dives on specific tickers you request for just €4.99 a month. And over the next few months, we're aiming to cover all of the S&P 500 stocks. Members get exclusive priority access to that content.
And if you just want a one-off deep dive on a specific company you're interested in, you can drop us a super thanks on YouTube and look into it.
That's right. Thanks so much for joining us on this deep dive.